So today we'll be reviewing the month of October, looking back at economic data released over the past month, and also talking about how our portfolios are currently positioned. October can often be a month that causes unease for a number of investors. Looking back, we've seen notable stock market crashes in both 1929 and 1987. However, this time October didn't prove to be a disappointment for investors. In fact, we saw equity markets continue their recent climb, rising to new highs. In the US, investors were encouraged by strong third quarter corporate earnings and also the release of President Trump's proposals for tax reform. This helped propel the S&P 500 to a new high and the Dow Jones Industrial Average breaking through 23,000 for the first time. These strong equity market gains weren't just seen in the US. Global markets also reacted strongly, with markets in the UK, Europe and also Asia performing strongly. The current broad-based economic upswing is maintaining its momentum. The International Monetary Fund raised its growth forecast for 2017 to 3.6%, rising to 3.7% in 2018, driven by increased levels of trade and consumer confidence. The UK economy grew by a better than expected 0.4% in the third quarter of this year, picking up from the 0.3% that we saw in the first two quarters of the year. Inflation was also running slightly ahead of expectations, hitting 3%. This combination of higher growth and higher inflation prompted the Bank of England to instigate the first rate rise in over a decade, raising interest rates in the UK by 1/4 percentage point to 0.5%. Within our portfolios, European and Japanese equities have performed strongly so far. We retain a preference for these regions, believing they offer a combination of attractive valuation and superior corporate earnings growth. Europe in particular has fared well, despite the recent reappearance of political tension in Spain and the Catalan region. We remain cautious on government bonds within our portfolios, believing that long-term returns are vulnerable to both rising interest rates and also inflationary pressures. Earlier in the year, we made the decision to not only have a low allocation to bonds in our portfolios, but to reduce the duration by buying bonds with shorter maturities. We do, however, retain a preference for corporate bonds in our portfolios, bonds issued by companies where we believe that investors can earn a high yield. We maintain a number of diversified investment strategies, such as absolute return funds and momentum funds, to compensate for holding less in our bond weighting. In addition, we have a number of thematic ideas that we put in portfolios, such as oil, energy infrastructure, healthcare, and selected funds investing in technology stocks that have performed very strongly through this Q3 earnings period. Overall, whilst we remain well aware of the risks relating to recent geopolitical tensions and the fact that markets are trading quite close to their highs, we remain cautiously optimistic on the prospect for future growth.